Hey everyone, it's PJ here. Hope you're doing well. Happy Friday. Today is the 26th, I think. 26th, yep, Friday the 26th. Hope you're all looking forward to a good weekend. I've got quite a bit of information I'm going to go through today in our market update. There's a lot to cover. I've just had a quarterly update from Hedgeye, and I'm going to run through a number of slides and things today that should again reinforce where we're at in the current market cycle, economic cycle, and where we're at with the market. So I'll just lead off by saying, first of all, that we are still in quad three. We've transitioned out of quad four, which was deep quad four and depressionary in situation and in a depressionary environment. And we've transitioned into quad three, which is a recessionary environment. So what that means is, first and foremost, economic data has improved. There's no doubt about it. It has improved. We've seen the reopening of the economy. We've seen businesses reopening, the consumer getting back to business, and of course, things around the world sort of opening up again. I suppose to that end, we've also seen the number of cases of COVID begin to rise again, which is quite interesting. It'll be interesting to see how this continues to develop over the next few days and weeks. Of course, we've seen the cases in Australia start to rise again. The cases in the U.S. Seem to be continuing to rise. There's some discussions around the U.K. What's going to happen there? So we're really in a very weird period where I'll just pop over to this screen where we have the reopening of the economy, but there are some very, very serious and dangerous underlying conditions that I'm going to share with you today as I open up some slides and things to share with you. So first and foremost, I really appreciate all of the feedback I've been getting about the market updates. I do hope you're finding them useful. I'm trying to tell you as much as I possibly can about what's going on, because the environment we're in right now is a very difficult environment to make money in the share markets. Quads 3 and 4, as I've been, I suppose talking about this quite a lot now over the last few months, quad 3 and 4 are bad quads. They are typically when growth and inflation and interest rates are all sort of declining. The caveat to that is in quad 3, we do start to see a resurgence of inflation. I'm going to talk about that during this update. So what I suggest you do is, I don't know if you take notes or anything like that during these presentations, but if you do, you might want to have your notes ready to go or ready to take notes. And the other thing I might suggest is even replaying it a couple of times just to let some of this sink in. So I'm going to be talking about where we're at sort of right now, and then what we can expect for the rest of this year, because there's some really, I suppose, interesting developments that should start to occur really even from July. So first thing I want to just cover off is U.S. GDP. Now, a lot of what I do, a lot of the work that gets done, I suppose, pardon me, is around the U.S. Now, the reason for that, first of all, is that the data that we have available in terms of all of the metrics that input into a lot of the global macro data is very good in the U.S. Not as much in Australia, although there's plenty of great economic data that comes out of Australia, but the frequency of it in the U.S. seems to be higher than it is in Australia. And the breadth also seems to be a little bit higher in the U.S. But in any case, the other main reason, of course, is that what happens in the U.S. Can and does affect a lot of what else goes on around the world. So the first thing I just want to point out here is the expectations for GDP in the U.S. And we had a pretty bad number sort of come out in, I think it was in the March sort of quarter. But we're going to start to get GDP figures, I think, early in July. And as you can see from this chart here, they're all going to be deeply negative, deeply, deeply negative. And what that does to the market, who knows? Will they be as deep as that? Who knows? But the forecasting model that Hedge in particular uses is suggesting that we could see a year-over-year GDP decline of, approximately 10 to 12%. Now that is a pretty serious decline in GDP. Now the thing you'll note here is what will happen is will have been a deep decline. Then of course it'll have a less of a decline, but it'll still be a decline. And as you can see here, for the sort of next 4 quarters, starting from the second quarter of 2020, including that quarter, I should say, we're in negative GDP territory. Now, this is obviously not good for the global economy. It's not good for the U.S. economy. Negative GDP is never a good thing. Anyway, having said that, we could, as we get into the first quarter of 2021, maybe all the stimulus programs and all this stuff will have impacted this enough to where we might get these lines projecting back above 0%. But at this stage, not looking good in terms of GDP. The quarter-over-quarter projections, this is a little bit more interesting because obviously you can see the spike up in the quarter-over-quarter projections. This is comparing this quarter to the same quarter last year. And what you'll sort of see here is that we're going to have this deep a bad number for second quarter of this year, and then on a comparative basis, it's going to rise because we've had the reopening of the economy. So that's exactly what's going to happen. And then of course we'll have it sort of come back again. So I would be probably looking more at the year-over-year sort of projection than the quarter-over-quarter. But having said all of that, we're still going to see really bad GDP figures, and they're going to impact a lot of things. I just talked about inflation a moment ago and quad 3. And the thing I want to point out here, first of all, is we had quite a bit of inflation during the last 2 and a bit years, 3 years, and it really fell off or has declined, dropped off a cliff, but it is starting to rise again. So this is interesting because we've got to understand that when inflation declines, as it had been declining, that's when you're in that quad 4 environment. And when inflation's declining, typically the U.S. dollar is going up, which it was, of course. That's an inverse relationship to inflation. So a lot of inflation is driven by what happens to the U.S. dollar. So when inflation is falling, typically the U.S. dollar is rising. And again, that's what we saw, at least from the U.S. perspective. And so we're going to start to see, we already have started to see, and I'm going to show you some of the slides on this shortly, but we've already started to see inflation beginning to rise again. And that's why we want to be positioned right now for a stagflationary environment, which is, as I've just set up for you, growth is going to continue to be very bad, but we have inflation coming in. So that's a stagflation. That's horrendous for the consumer. It's really bad for you and me because things like healthcare and fuel and sort of the day-to-day things that we pay for tend to go up in price, and other things that we don't necessarily need continue to deflate. So technology, things of that nature, probably continue to get cheaper. So if you want to buy a flat screen TV, great, but the stuff that you need, like food and fuel and shelter, will tend to go up. So this is just a chart showing the forecast model for CPI, and as you can see, it was declining through the early part of 2019, and then just fell off a cliff in early 2020, and we're now seeing that begin to resurge. So again, the projection is that we're in that stagflationary environment probably for at least the next quarter, maybe 2 quarters. Again, it's a bad situation to be in, and it's not good for investment markets. It's good for certain segments of that, which I'll talk about shortly, but it's not good overall for the markets. What I want to go to now is sort of a discussion around the business cycle. So that's sort of a global macro look, and it's really a U.S.-centric global macro look of what's going to be happening with growth and inflation. Now, I didn't touch on interest rates, but I think it's fairly safe to assume that with the Fed's intervention and the Fed in the market now buying, and they've explicitly said they're going to do this in the market, buying treasuries, buying corporate bonds and corporate debt. We know that what they're trying to do is keep interest rates at, well, the lowest level that you could ask for, I suppose, during a crisis. They don't want to see interest rates spike again because that'll hurt housing, it'll hurt the consumer. So again, they want to keep interest rates low. Now, interestingly, in Australia, the RBA, I think Lowe had a speech this week where he indicated that Australia is targeting the 1, 2, and 3-year rates of the Australian government bonds to keep those rates pegged at 0.25%. So effectively what they're saying is in the very short term, they're trying to keep the cost of money really, really low. So that's on the 1 to 3 year basis. And this is why you're seeing at the moment some really good 1, 2, and 3 year fixed rates with your lenders because of what the Australian Federal Reserve is doing, Reserve Bank of Australia, I should call them the right thing, the RBA is doing to keep interest rates low. So again, as interest rates are low because they're trying to get stimulus, effectively create and get stimulus in the economy going. But this chart, and I've shown this before, where it's showing you a number of the recessions and even the depression over the last 100 years that have occurred and the duration of those things. So this is a really important thing. I've talked about it before. I want to reiterate it because I know, I use this terminology FOMO, fear of missing out, from time to time, and I kind of say it tongue in cheek, but it's actually a real thing. And typically, what happens is that people will see the stock market because that's a very obvious thing. We see it; it's priced every day. You see that start to go up, or it's going up, and you think you're missing out on something. And the thing I've been trying to really say to you is there's a long workout period for what the type of crisis that we've been in. There's going to be a very long workout period. And I'm just using this data to express that. So if you look at, I suppose these three metrics down here at the bottom: minimum, the median, and the max. So what this is saying is of all of these really major economic calamities that have happened where GDP has dropped a lot, and what's been the duration of these things, the minimum duration has been 7 months. And that was a real, if you just find that one here in the 1980 period, January 80 to July 80, only 6 months or so, 6 to 7 months, GDP only went down 2.2%. And so we're already well beyond that threshold. So one could argue that we're not going to see a very short duration time frame to work this out. So 7 months, and we're only, I'd say, probably 3 to 4 months into this. So if you go from March to June, what's that? I guess that's 3 months, and let's split the difference and say 4. We still have, at least by that metric, have another 3 months of workout period, but it's more severe than that. So again, the median is 11 months. And then, of course, if you go to the extreme of the Great Depression, it's 44 months. Now, I suspect if you took the Great Depression out, the median would probably pop to maybe, I don't know, 13, 14 months, something like that, maybe 12 and a half. But the point that I'm trying to make here is that there continues to be no rush to get back involved in equity markets, at least from that sort of rip-roaring bull market where we're going to see an awesome economic recovery. Interest rates are low, growth is up. You can just pretty much throw a dart at the stock market and make money. We are not in that environment yet. So we're actually in an environment where you, and as in me, as your advisor, has to be very selective about what we own and how much capital we put to work in the markets, because again, this is one of those times where it is exceptionally difficult to make money. A stagflationary environment is very deceptive. And what I mean by that, and just this is worth writing down what I'm about to say for those of you who are really trying to maybe get better at this. But what happens in a stagflationary environment is companies get cheaper. So valuation goes down. And what investors do is they go, oh, look how cheap this company's stock is. Look at the valuation of this company. But the problem is without earnings growth and cash flow growth, and I'm going to talk about this in a little bit, it doesn't matter that the company's cheap because it's going to get cheaper. So this is something that sort of was a real source of consternation for Warren Buffett back in the 80s when there was a lot of stagflation, because he's a value investor. What he does is he looks for value, and he could not understand why companies were trading he could understand it, but he would buy companies trading at 2-3 times book value or something, which is exceptionally cheap, but the market didn't automatically figure out, or not automatically, but it took a long time for the market to reprice those assets higher, because again, the other metrics that input into that being corporate cash flows and earnings growth weren't there. So it was just a real interesting period. It's worth pointing out that even the great Warren Buffett was confused or stumped by the stagflationary environment back then. So anyway, he's obviously done well over time because he's a long-term investor, and of course, markets eventually do figure these things out, and we return to periods of growth and so forth. But anyway, all I'm really trying to illustrate for you here is, again, there is no rush. There is no big impetus that I can see right now to invest all your money into the stock market. And I know I have from time to time conversations with people about this, and I get asked the question, oh, when are you going to invest again, and when are you going to do this? But I want you to understand, again, where we are in the cycle, and that really for me right now, and I say it occasionally in notes and things like that, right now, preservation of capital is absolutely, that is number one. Trying not to lose money in this environment, that is the key. So that's ultimately what I'm really focused on right now is not putting capital at risk of loss. Now, obviously, as all of you would know, I am, putting some positions on and doing a few things again. I'll talk about that in a second. But I just want to reiterate that where we are right now is not a bull market. We are in a bear market, and there is a longer workout period than what the media wants us to think there should be, and of course, everybody else is in a hurry to recover. So, and to illustrate that further, there's and for those of you that haven't studied economics or don't know anything about this, just listen up, but maybe not you don't have to take terrible notice of it. But one of the things, of course, that businesses do is they build this thing called inventory. And inventory can be any number of things. If you look at, say, a retail shop, right, it's the clothing they have on the shelf. It's a manufacturing company. It's the widget that they build. It sits on the shelf, whatever. And there is a workout period for inventories where what happens is inventories build and then they shrink. And this chart is basically illustrating that the cycle of the burn off of inventories is still very young. So we're only at sort of a minus 8% drawdown in inventories at the moment. But if you look at the last few recessions and other poor economic periods that we've had, the median drawdown is something like, 30%. And we're only at minus 8. So even if, this somehow ends up being a mild recession, which of course it isn't, we still have a long way to go for corporate inventories to decline. So again, that's going to translate into lower prices, more sales as companies try to liquidate stock and get inventory off their books. That's what's going to happen. Now again, that's probably deflationary in the sense that they'll have to discount to sell some of this stuff. It might be good for the consumer, but it's going to be bad for corporate cash flows. So on one hand, the consumer might win because of that, but on the other hand, investors lose because if they're invested in those companies that have to run inventory down and have to discount to do it, well, these companies are going to be under a lot of pressure. The next thing is the Capex cycle. So this is capital expenditure. This is businesses investing in plant and equipment, I suppose buildings and all this sort of stuff. So capital expenditures. And again, we are still early days in the Capex cycle. And as you can see in these downturns, the Capex median trough is 10%. We're only at -3. It was already declining. I've talked about this before, but it was already declining heading into this. But COVID's going to make it even worse. And again, it could go, if you look at a period like 2007, December to June, it was down -16%. So, somewhere the rubber will hit the road between where we are now, -3, and probably -16. Who knows? This could set a new record and go even lower than that. I don't know. But we do know that businesses are still under a lot of pressure, and they are still very cautious about rehiring. Obviously, they're going to be very cautious to protect cash flow, so they're not going to necessarily be investing in any capital expenditure. The next slide is sort of talking about labor. And one of the things that happens during times like this is you have the cost of labor has to start coming down. And what drives that, of course, is the unemployment rate. So I think I have some slides on this. Hopefully I do. But right now, the continuing jobless claims in the U.S. are something like 43 million people. That is just unprecedented in terms of the number of people and the fact that they are still sort of elevated and rising. So even though the economy is reopened, we're still seeing a very, very high level of unemployment benefits being claimed and people on unemployment benefits. It's not good. But anyway, this chart is basically showing that we'll need to again see that cycle downturn where labor unit costs drop by a certain percentage and they work through to find that equilibrium in the economy. And last slide that I'm going to show you on this particular topic is what I've been talking about, the corporate profit cycle. So again, and I keep talking about this, I've referenced it a number of times in presentations and market updates recently, and that is we have yet to see the full effect of the decline in company earnings. So again, we're only here at sort of -6% at the moment. That's March of this year, to right now, as of June. And if you just look at the last few big, downturns we've had, the median is a -40%. The median. The worst it was back in 2007 when we had the financial crash, which was -53%. And where we're at today is arguably worse than the 2007, 2008, 2009 GFC. It's worse. So what that means is that number has a long way to go down. Wall Street is thinking foolishly that we're on this sort of profit recovery all of a sudden. We are not. That is a false narrative. It is bullshit. And there is a long way to go in the profit cycle. I've shared with you some previous charts. I don't know if I have them in this chart down. I'm not going to try to find them right now. But one of the things that's happening with corporates at the moment is something like 50% of the S&P 500 actually has negative cash flow. And there was some other metric on the S&P 500 that was just really astounding. But it just goes to show you that there's a number of companies that are in probably dire financial circumstances. And I spoke about in my last market update the corporate credit cycle, and I think I might have some slides to show you on this. Let me just flick over here. Sorry, I was a couple more things on overall economic health. This is just a chart showing private investment growth. And as you can see, if you just look at that arc, it kind of smooths it out nicely, but it's clear to see it when that arc is there. It was already declining. So investment, private investment was declining. It was already declining pre-virus, which is what this is all about. And we'll probably have a number of negative bars here going forward. The next thing that I wanted to show you again was, okay, this is the sales growth. I think it was the sales growth number actually for the S&P 500. So you may recall back in, I don't know, probably January, maybe December, I was talking about the fact that revenues were slowing, and sales, I may have mentioned sales were slowing of the S&P 500 companies. So we were already entering a slowdown, an economic slowdown. As it happens, we just had this event, which is called COVID, come along and really just make it even worse. So, instead of probably a quad 3 environment, which we might have had if COVID hadn't turned up, we had a deep quad 4, and now we're into quad 3, that recessionary environment. But the point is that revenue growth will continue to decline for a period of time. So, again, don't get your hopes up on any sort of big market recovery. And that's one of the key drivers of stock market valuations, right? Is, are companies growing their revenue? And if they're not, then companies' valuations cannot be elevated. It is just that simple. And I use the term economic gravity a lot because it basically means that gravity, it pulls you back to earth. It pulls you in. And eventually these ridiculous prognostications that some people have about corporate earnings growth are going to get reset. And that's going to actually start to happen from July 1, as we start to get more reports and so forth. And again, this goes to the earnings growth, where it's basically showing us that back in 2018, after President Trump got elected, he's a really pro-business president. And so there was a whole bunch of promises that he made to get elected, which were things like tax reform and estate tax reform and all this sort of stuff. But basically, he wanted to do a lot around business tax reform, which he did and got passed. And so we saw an unprecedented spike in earnings in companies, and that's what this period is highlighting. But now, we don't have any of that anymore. And of course, we're running into the declining earnings, declining cash flows for businesses, and we're going to see earnings of companies stagnate and be negative, or just very small amount of growth. So again, what that means is that this bubble that we're in right now in the stock market, which, believe it or not, even though we're still down about 10% or so in the stock markets in the US, and in Australia, we're, I think, still down about 15 or 16%. And a few of the other indices are still in sort of crash mode. If you look at the Russell index, it's still down somewhere around 18 to 20%. From here, it's probably only going to get worse. Now, it's just a matter of time in terms of when does the market catch up to that. Now, I think that was all as far as, a couple other quick things I'll just share with you. This is a really interesting chart about households. And this is in the US, but most households, 50% of households in the US had less than $1,000 of savings. Astounding, really. And what it pretty much tells you is that people were not prepared or didn't have the resources available to them for a downturn in the market. So, and when I say downturn in the market, I'm really talking about them losing a job, having unexpected expenses that come up, that sort of thing. Really, really scary stuff. I don't know what the metric is for Australia. It's probably a little better for Australia, but it wouldn't be much better. It also, the metric that we've got from the US is that 50% of small businesses would not have enough cash flow to survive more than a couple of months. So again, really, really scary metrics. And this is why, as the economy reopens, we're going to really start to see who has been unable to make it and who will struggle to make it, and then eventually probably fall over again. So businesses and consumers both not in great shape. In fact, exactly the contrary. Now, there's a whole bunch of other metrics here that I could share with you, but actually, one of the key things I will share, which is this chart, which I think is quite telling, and this is something that we know to also be true in Australia, and that is, of course, the government's come out with all these stimulus programs. We have Job Seeker, we had this first home buyers stimulus package. We've got a number of things that the government has done to try to, smooth out or help people get through this period of time. And that's fine. We've had forbearance and other programs that have been put in place by lenders. You can delay your mortgage payments and all this sort of stuff. But at some point, all of that stuff runs off, right? You no longer have the mortgage-free period. You no longer have the job keeper. You no longer have any other stimulus program that might be available. And most of those, if not all of them, unless the government renews them or starts another program, all of those will have ended by the period of sort of September to December of this year. And that's in the US and in Australia. So again, what we're going to start to see happen is as these stimulus programs are wound back or withdrawn or not renewed, we're going to see if employers are going to put people back on full-time salary or whether they will retrench employees, and all of that sort of stuff. And really the point of this particular slide is to say that the government has fired the bazooka, right? They have stimulated. And as you can see, this is just off the charts sort of stimulus. They probably had to add more bars to this thing because the last spike was back in 2008. I mean, if you just look at that, that's $1 trillion, but they've put in $3 trillion of stimulus so far, and even more, I dare say. But that's just unprecedented. So that has happened, and yet the economy is still sputtering. So again, this is a cause for concern. See if there's anything else I got here that's kind of interesting. So again, I talked about jobless claims, and we're seeing that sort of this upward trajectory has stopped going up, but by the same token, we're not seeing a downward trajectory just yet. It's sort of flat, as this is indicating. So the question may then become, well, will we actually see another spike up as the economy reopens and businesses try to work out whether they want to shut permanently or retrench part of their workforce or whatever shape or form they reopen and try to stay in business? We will see if that number, at least in the US, and of course we'll see it in Australia too, whether that number begins to rise again. I think that's probably all I really wanted to show you on that one. So I'm just going to flick over to, so I just want to flick over into some market stuff real quick, and then I'll wrap this market update up. And thanks for bearing with me as I go through some of those things. I think it's important for you to really understand what's going on with the economy, because many of you, I've had conversations with you. I know that, you've had to take pay reductions. Some of you may have had to shut businesses, or well, actually, I know that some of you have had to shut businesses. So I know that you're part of this, this fallout from what's going on. And then the rest of you who have been lucky enough to keep jobs and to work through this, you're probably wondering, well, what's next? And, how do I first of all protect my capital, but then how will I eventually grow it? So I just wanted to remind you, one of the key, there's two key metrics that I've learned probably over the last 6 to 12 months that drive market conditions. The first one is, and this is not in any particular ranked order, but the first one is volatility. So that I talk a lot about, the VIX, the volatility of the market. And what you'll notice, if you watch this metric over time, what you'll notice is, of course, we had this massive spike in volatility. This was when the market was crashing badly. People were just, hitting the absolute sell button on everything. And volatility just went through the roof. And of course, the markets crashed. We then had, volatility just slowly run down to a point where we could sort of maybe start to reinvest in the markets, in equities. And then we've had a bit of a spike, and now we're entering this. I probably talked about this before, but people have talked about having a V-shaped recovery, and I've suggested that it's going to be more of a W shape. And what that means is that as the markets trade and try to find equilibrium and all of that, we're going to see these runs and these sell-offs, and run up and sell off and run up and sell off. And for someone that's a really good trader, and I'm not purporting to be that, nor would I trade your retirement money, which is for most of you what I'm managing. That's not how we invest retirement money. It's not a trading account. I'm just pointing out to you that markets are going to continue to fluctuate a lot. And I do think that we may see some sort of rollover and further sell-off. Now, whether it goes back down to the lows of the initial sell-off, or stops somewhere halfway or 3/4 of the way to that point, I don't know. We'll know when we get there. But again, one of the key metrics to keep your eye on is VIX. Now, the ticker, as you can see, is VIX. And just as a reminder, we need to see that number for me to say to you, it's all clear now. We're headed towards quad 1 or 2, and I want to invest all of your money into equities and a portfolio. We need to actually see the VIX below 20, and like well below 20, probably like 16, 17. And we want it to stay there. So if you look at this chart that I've got on the screen here, if you can see that, this period of time here where the VIX was just clearly it was just numbingly doing nothing. And the market was continually sort of rising to the point where, of course, we had the big spike, and now the markets have shit themselves, and it's just been, a ridiculous up, down, topsy-turvy, what do we do now sort of moment. So what I'm just saying to you is that the volatility of the market is critical to understanding the decisions that I'm making to stay more heavily invested in cash, and also what asset classes to potentially own. The other thing that is really worth following, and this drives a lot of what goes on around the world in terms of investing decisions, is the U.S. dollar. And the U.S. dollar has a number of correlations to a number of markets. And of course, I'm not going to go into the economic lesson here, but the U.S. dollar is the global reserve currency. As the dollar falls in price relative to other currencies like the pound or the Aussie dollar or the yen or whatever, inflation begins to rise because all commodities are priced in terms of the dollar. This is why in a stagflationary environment, which is low interest rates, low growth, but rising inflation, I want to own things like treasury protected TIPS, which are inflation protected treasuries. I want to own gold. I want to own some of the gold miners, although they're in equity, so I have to be very careful there. And I'm going to probably have, I'll start to do a little bit of cherry picking around certain things, like even technology. So tech does reasonably well in quad 3. Interestingly, the Aussie market does not, and that's one of the things I just wanted to show you as well. I get an absolute treasure trove of data from Hedgeye, and the thing I'm just going to draw your attention to here is the Australian quadrant map and how the ASX 200 performs in the various quads. And as you can see here, quad 1, it does have a high expected value. It does have a positive return. Quad 2, similar. But quads 3 and quad 4, it does not. So the point of this chart is simply to show you and re-illustrate what I'm saying about, the caution that I have, particularly in the Australian market, but that we have to be super careful about where we invest at the moment. So just to close off, because I know this is getting a little bit long, this video, but just to close off this entire conversation, And to quickly recap, and then I'll just tell you where I'm investing right now, what I'm looking for, and then I'll wrap it up. What was I going to say? So, talked a lot about so far the economies and what's going on in the world, and the fact that we have still a lot of time and space before this whole thing works itself through. So in other words, there's no rush to do anything. We can have absolute patience, and the reason we can have absolute patience is because I have successfully navigated away from the major market carnage that's been caused. So in other words, you've got all of your capital. For the most part, all of your capital is intact. Juxtapose that against somebody who's stayed, fully invested through all of this. Well, they're probably still down 10 to 15% in their investment accounts, perhaps more, perhaps less, but still they are down. And probably looking at these market recoveries right now, thinking, oh yay, we're gonna get back to where we were. Well, again, this is why I'm real pleased that I got out of the markets before they started to tank, and have sort of tried to trade around them a little bit to generate a little bit of alpha against what is a market that continues to decline. So, and so that's the economic wrap up. Talked a little bit about specific stuff around inflation and corporate earnings, and that they're going to now drive the second phase of this downturn, which is as soon as companies have to come clean and say, well, A, our earnings are down, and B, our forward guidance, either we can't give any or it's really bad, investors are going to start to discount and sell off assets. So expect to probably see that. So finally, where are some of the safest places right now to invest? Well, gold, as I mentioned, is a key benefactor of a stagflation. As inflation rises, gold outperforms. Gold miners will to a lesser degree, but they will catch up, of course, because if gold really takes off, then gold miners will really take off. But they will be a reasonably decent hedge against inflation because, of course, their underlying asset is gold. Inflation-protected treasury securities, which you own. And I'm sort of looking at real estate and utilities. Now, I got out of those positions prior to this big market sell-off because we were clearly headed into quad 4, which you don't own those things in quad 4. That was going to be deep, deep quad 4 as well. But they have come back now as far as being in a bull market and being in a trending bull market. Now that could change if we see some, swift and really sharp negative downturn in the markets. This is one of the things that I'm nervous about at the moment because the market's looking, again, like it could correct again. So those positions are on a pretty short leash. So I'm going to see how they go. But gold, the treasuries, and I'm actually looking for an opportunity to buy tech. But tech's had just a really, really strong run of late. So I'm hoping we get, some sort of market correction in tech so that I can put on some tech positions as well. Other than that, it's really going to be cash. And so that'll be AUD or USD and commodities. So the other thing that I'm looking to try to get some other positions built up in will be some sort of commodity type investment. And I'm trying to find something that's got a good balance in it. They're harder to come by because there's just not a lot of ETFs and things out there for commodities. So it's a bit more of a difficult space. Having said that, I'll see what I can find, or I may just end up buying companies that, kind of like in the gold situation, you buy a gold miner, they have gold in the ground. Well, you could buy, a food manufacturer or grocery store or something like that sort of gives you a similar investment. Anyway, so to finally close it all off, just to remind you, we are in quad 3. It's a stagflationary quad. There's a lot of time and space to go now between now and when we actually start to see a point of the cycle where I can say to you, now's the time. All the money's going into the market. We're going to start buying everything in sight because we're entering a new growth phase. Long time to go. That's going to be maybe first quarter of next year, and even then, who knows for sure. We need to get through the back half of this year first to really see how that goes. So thanks a lot for paying attention to this market update. Again, I hope you're finding this stuff useful. Right now, patience is probably the key. We are in an exceptionally difficult market environment, and I think you'll continue to see that play out as the volatility of the market continues to fluctuate and bounce all over the place. It's going to drive markets up as volatility comes down a little bit, and then when it spikes again, markets will sell off. So just be attuned to that. And as always, if you have any questions about anything, please don't hesitate to give me a call. Have a fantastic weekend, and I'll look forward to leaving the next market update. Take care.